Hello Apex entrepreneurs and welcome to this video. If you're a beginner and you want to learn how to invest in stock markets, then this video is definitely for you. Some people think that investing in stock markets is difficult and it requires a lot of research and dedication. Some other people think that stocks are risky and they prefer not to invest, so they keep their money in savings accounts. The sad truth is that if you keep your money in a savings account, inflation will eat it and your purchasing power will deteriorate. In this video, we will show you the top 8 tips to teach you how to invest in stock markets and make money while spending no more than 1 hour per month. Yeah, you heard that right. 1 hour per month. This video is extremely important if you want to make passive income from stock market investing. So please watch it till the end. Take notes and smash that like button if you're enjoying it so far. So, are you ready? Let's start. Tip number 1. Always be disciplined and invest in the long term. I understand that many of you guys want to make money so fast, and that's really normal. Humans are by nature greedy and they want to make money fast. A lot of beginners make this mistake. They buy a stock and then when they see that they have already made 20 bucks, they sell it and celebrate, thinking that they can replicate this behavior as much as they want. Unfortunately, that's wrong. Nobody can predict the future with accuracy in the short term. Nobody. There are a lot of fluctuations and news that you can't control and that influence the stock market prices. So, the best thing is to bet on the long term. Warren Buffett once said, "Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. So, you have to invest in safe companies with big capitalizations that you think will still be competitive in 10 years. Take Coca-Cola as an example, which is the world's largest beverage company. Although we saw huge crashes in 1999 because of the dot-com bubble, and in 2008 because of the subprime mortgage crisis, and in 2020 because of the recent crisis, we can see that the stock is increasing in value if we look at it from a long-term perspective. You could have more than doubled the value of your investment had you invested in Coca-Cola 12 years ago. So, always think about the long-term value of your investment. Now, back to our tips. Tip number 2. Invest in companies that have a solid track record of dividends. For those who don't know, a dividend is a sum of money that the company pays to its shareholders, and usually it is a distribution of profits. So some companies give their shareholders a part of their profit to reward them for holding the shares. In this type of company, you should invest because you will be getting dividends every quarter or sometimes every month. If you want to know more about dividends, we already uploaded a complete guide that will explain to you everything about dividends. You can click here to watch it after you finish this video. Let's go back to our first example, Coca-Cola. If we go to their website, we can see that they have a solid track record of dividend distribution. So even during the violent crisis of 2008, Coca-Cola distributed dividends to shareholders. The average return on investment of Coca-Cola dividends is near 3%. Which is better than most savings accounts. So, if you invested in Coca-Cola, in addition to 6% average growth in the stock price in the last 10 years, you'll also get a 3% dividend. So, almost 9% average return on investment per year, which is more than great. Let's move to tip number 3, which is the most important tip in this video, and you should definitely follow it, so take notes. Tip number 3 is, subscribe to this channel and hit the notification bell. And no, it's not a joke. By subscribing to this channel, you'll have access to a lot of videos that will help you invest wisely and master your personal finance and make money while you sleep. We have a complete playlist on investing, so don't hesitate to devour it. You'll find the link in the description. Tip number 4. Reinvest your dividend. So let's say you invested $10,000 on a stock. That gives you a 5% return on investment in a year. So after 1 year, you got $500 of dividends. Instead of taking this $500 and buying stupid liabilities like a new fancy handbag or a new iPad, reinvest this $500 by buying more shares of the same stock. If you reinvest your dividend, next year you'll be going to earn 5% of the $10,000 you originally invested, plus the $500 you earned the first year. So you'll be making 5% of $10,500, which is equal to $525. You see, your annual income increased by $25, and now your capital is $10,500 plus $525, equaling $11,025. If you keep reinvesting your dividend, you're gonna profit from the power of compound interest. The amount of money you'll be making out of dividends will grow following an exponential curve. And at some point, instead of making only $500 per year out of your initial $10,000, you'll be making $1,000 a year, or maybe $2,000 a year, if you keep them for the long term. And now let's move to tip number 5, which is diversification. And here comes the famous quote you all know: don't put your eggs in the same basket. And this is a great tip for beginners. If you invested your money in 1 or 2 companies, then you are taking a big risk, because these companies might go bankrupt and you might lose a lot of money. That's why we recommend you to diversify your portfolio. And one of the most efficient ways to diversify is to buy index funds, or ETF. And we recommend you as well to destroy the like button below if you are enjoying this video, because if you do so, you will help this video reach more people, and you will help other beginners to know where they should invest. So for example, let's say you bought the S&P 500 Index Fund. The S&P 500 Index Fund includes the largest American companies listed on the New York Stock Exchange, or NASDAQ. It includes companies like Apple, Google, Facebook, Coca-Cola, and Amazon. When you buy an index fund, you are betting on the economy and not on one company. So if one company went bankrupt, there are 499 other companies, and some of them might be performing well enough to protect you from losing your money. The average return on investment on S&P 500 in the last 90 years is 9.8% a year, which is a great way to grow your capital. If you think that a certain industry sector will flourish, you can buy ETF that focuses on this sector. For example, if you're an optimist about the energy sector, you can buy an ETF that focuses on the securities of oil, natural gas, and alternative energy companies. This way, you are betting on the whole sector and not on one company, and this will reduce a lot of your risk. Now, let's move on to tip number 6. Do not speculate. A lot of people love to speculate in order to make money as quickly as possible, and one of the most speculative industries is the tech industry. A lot of new companies are going public every month. For example, if you're a tech geek and you understand very well what you're doing, then why not invest in this type of company? You can make a lot of money. But if you're a beginner, we don't recommend you do so, because in the tech industry, it's very difficult to predict which company will flourish and which company will vanish. What could be considered as a promising technology now could end up failing 2 years from now because of another, more powerful technology. So unless you know exactly what you are doing, stay away from speculation. Let's move on to tip number 7. Buy when everybody else is selling. During a crash, people get scared and they want to protect their investment. So they rush to sell their stocks, even at a loss, in order to avoid losing more money. And this will drive the stock downward. But if you understand economic cycles, you know that sooner or later the market will recover. Take an example of the NASDAQ index. Even if you bought all your stock on the 10th of March 2000, which is the very worst moment to buy stocks in history, you would have recovered 15 years later. So, don't be afraid to buy when everybody is selling, because if the companies you are buying are solid, they will definitely go up with time. 8th and last tip for this video is to never invest less than $500 at a time. This tip is very important, especially for beginners who tend to invest in small amounts. Every time you invest, there are fees you pay for your broker. It depends on your broker, but the fees could vary between $2 and $50. So let's say you invested $200 on a stock and you paid $10 fees. Well, that's a 5% automatic loss on your share that you might have to wait 1 year or 2 to compensate. But if you invested $2,000 and paid $10 transaction fees, then you only lost 0.5%, which is much easier to compensate. So, do not ever invest less than $500 on a stock. These are our top 8 tips to invest. If you find them interesting and helpful, share this video with others so you can help them as well. Before leaving, we invite you to visit the description below, where you'll find many resources to help you make money from the comfort of your couch. You'll find the books that we recommend to help you acquire the right mindset for success, a free video course that will teach you how to generate passive income and how to create a six-figures online business, and much more. By the way, if you're still here while the music is running, here are 2 videos that you'll love watching. The first one will show you a summary of the greatest investment book of all time, The Intelligent Investor, and the second one will teach you how to become a millionaire in your 20s or early 30s. Just click on either one of them on the screen right here.